Welcome to Revere Asset Management's Your Money with Danny Stewart
The market will always overshoot to the downside and to the upside.
and Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
Hello? Hello? Yeah? Okay. All right, thanks. Hey, Don. The advisor from Pie Charts or Us called. They want their light chart back because the clients are bitching. They reviewed their portfolio and they're not happy. And the market made a lot of money last year and they got a very, very mediocre return. They're looking at their accounts. They've got emerging markets. They've got all kinds of stuff. They've got, that bastion of civilization, EU, the European nations. Of course, that sucked too. It's done terrible for the last 5 years. Why would you own it? Hell, I don't know. And then you have a slice of bonds in 2022 that lost 30%. Folks, why are you owning asset classes that are in downtrends and are going down? Why do you own a whole basket, a whole pie chart of a little bit of everything? Let me explain it to you, folks. The advisors, right? They're investment banks. They've got to spread the money out amongst all their clients, the municipalities, the emerging markets, Europe, the companies, technology. You're not the client, you're the product. They're taking your money and spreading it out to their clients, right? So the light chart guy, the light chart advisor brings you in and says, ooh, this emerging market fund didn't act very well. We need to change the manager. And he didn't do very well. I think he got divorced or had some, whatever. And so he's been underperforming as of late. And so we're going to switch it out with this other emerging market fund. Folks, maybe it's not the fund. Maybe it's emerging markets. That sector is no good. And all of the emerging markets funds have done pretty poorly in the recent, in the last 8-10 years relative to the American markets, because that's not been the place to be. Let me tell you another secret that you may not be aware of. There are more mutual funds, and now ETFs, than stocks to put in them. Let me repeat that. There are more funds than stocks you can put in them. So when you got this Pie Charts or Us, and you've got some, couple different large cap funds, you think you've got diversification, folks, you own Microsoft 4 different times. If you want to buy Microsoft, just buy Microsoft and not have the carrying cost in the mutual funds. Okay? That illusion of diversification is just that. It's an illusion. When the market goes down, the correlations grow together. It all gets killed together at different rates, but it all goes down. All right? On the way up, you want enough diversification so one stock doesn't kill you if they're lying, if they're cheating on the books or just anything. Something happens out of the blue. So you want enough diversification so you're not just all your eggs in one basket on the way up. But on the way down, you may not want any eggs in that basket. You may want defense. Anyway, I'm just saying Wall Street is spreading your money to their clients. And and it doesn't matter whether it's Merrill Lynch, Fidelity, all of them. They've got that, whether it's target date, asset allocation, with some rebalancing is what I was just talking about. So you come in at the end of the year and you've got immediate bad return. And so they'll switch out a few funds. So they've got deniable culpability because they're not managing your money. They're taking you and playing golf with you, right? So now they'll trade it out and you'll get the same thing. Folks, here's the problem. That Pie Charts or Us, that asset allocation model, whether you call it lifestyles funds, target date, it's all the same stuff. It's going to make long-term around 7-8%-ish. And you're going to have to go through bear markets every 4 or 5 years. That's just the way it is. Okay? There's a better way to invest. Okay? And look, so there may be a problem with their system. There's conflicts of interest. So you need to ask yourself why. Okay? Now, so you need to look at your advisor, or if you're your own advisor against medical advice, Are you really doing all kinds of work? Look, investing is very hard. It's seriously very hard. These guys get up a couple hours before the market. They've already screened for all the stocks across the universe, narrowed it down to 30 or 40, 50 stocks, and then they're looking at the technicals of those, which ones look the best, and then we have a call before the market opens, and everybody goes around the room with their ideas, and every single stock and every portfolio we have a plan for. Are you doing that? Are you getting up and doing that? Do you have people with eyes on the target, on the portfolio during regular market hours all the time? Just asking. All right. So before we go to the team, because we're going to talk about that, we're going to talk about what they're looking at, the positions, what they're focused on, and Donna's going to tell you about the markets. By the way, we put this out every day the market is open. Okay? Now, so I'm going to go to the mailbag first. And by the way, you can send us an email anytime, and we'll talk about the stock or an idea you have in the mailbag. So this is on 219. This is actually a solicitation capital. Hello, Don. This is so-and-so from Blank Capital. We offer a 9% fixed return through varied secured assets promissory notes, consistently paying income in an IRA-friendly environment. Don, is it liquid? No, it's got a 3-year lockup. However, a 3-year lockup. However, for the right size check, we could consider more liquidity. Would it be worth a 15-minute call? Don, no, we don't get involved with illiquid securities. Classic. All right, next one. This is MB. Perhaps this is an article in the mailbag. Perhaps this is a growth industry to track. Welltower and Ventus, VTR is a ticker. And it's a Wall Street Journal article, aging baby boomers rekindle the senior market. And then another one in Fortune, the booming housing crisis pace toward, basically it's saying the baby boomers are all retiring. The senior housing market's going to be on fire. So we look at those, and we look at Well and Ventus and see how they're doing. The guys will talk about that. In the show notes, there's also how to avoid an inheritance nightmare. The easy way to do that is just call me. When the empty nester should downsize, that's an interesting article. And the biggest retirement risk most advisors missed. I'll save you. That's the longevity. Remember, that's people living longer. You can't make the 7% pie charts or us return. You're going to have to do something different. Okay. Then Double Line suggests Microsoft debt may be safer than treasuries. He's got a good point. And I threw this one in for a joke. 3 ways to get business if you like to play golf. That's for the advisors, folks. Sorry, I had to get a drink. All right. Now, I want to get directly to this. Now, this is from TT, and this is actually I can't remember whether I read this on the mailbag last time. I don't think so, but I want to toot our own horn again because directly after the show, I think this came directly after the show when I talked about the converted pie. Oh, this guy's a converted pie charts or us guy to a full-fledged stock nerd, right? And he said, wow, best podcast ever. You guys are a friggin' miracle. Love you guys. What a great small investment company. We're actually middle-sized now. So lucky to have found you. Not lucky, though. God gave me one. I've been praying for after years of wandering in the desert with half a dozen pie charts or us firms. You're the best. And then I said, thank you for the kind words. This will definitely make the mailbag next week. Cheers and have a great weekend, brother. And then Don, thanks, TT. Hard work and common sense is what separates us from the crowd. We appreciate your support. Now, here is him following up a week later, because this guy's a hard stock nerd now. And this is on 227. Hey, Dan and Don, I listened to the market recap this week. Y'all are saying y'all sold all individual stocks. We got defensive. And he said, but today I'm still looking and I see shares of NVIDIA in my Revere managed non-qualified brokerage account. Is there a mistake? Schwab won't let me take a screenshot or I'd show you. Don, great question. Around 60 clients, or 7% of the accounts, have significant unrealized capital gains in NVIDIA. We've hedged several times when it got weak, and did so again today after the negative earnings reaction. Any NVIDIA loss will be offset with the gain in NVDQ if we decide to book the gain, so the long-term tax hit is minimized. We will discuss this periodically, but not in our model portfolio, and that is why it's not brought up daily. So, folks, listen, if you've got a question or comment, just go to revereasset.com. Up in the right-hand corner. There's a subscribe button. You can get in on our email list. And you can also just go to YouTube, Revere Asset, and just search for that, subscribe, and this podcast will go in before the market close on Friday. On the email list, you'll get it Saturday morning. All right. In any event, these guys do a video every night telling you exactly what they're doing in about a 10-minute. And then we do this podcast about an hour long every Friday morning. So we put out more content showing you what you're doing, pulling the hood back and fully transparent more than any advisor that I'm aware of. Okay. So with that, and the reason this is so important is because that article, that longevity risk, people are living to 90 or 95 or 100. Look, if you die real quick, you don't have a problem. The problem is not if you don't live long. The problem is what if you do, right? And that pie charts are us with 40% bonds are not going to get you there. That 6-7% with longevity now, that old modern portfolio pie charts are us is you need to look up sequence of returns. If you don't know what that is, call me, 855 Real Wealth. All right, with that, I want to go to the team. And before I do that, I want to ask you to listen. And when you listen, does your advisor sound like these guys? Or does he just want to take you to lunch? Don doesn't go to lunch when the market's open. Don?
Dan, thanks. There's our last podcast was 2 weeks ago, and obviously a lot has gone on in the market since then. And if you've been following the nightly videos, which is why we do them, if you just listen to the podcast, you're missing a lot. We didn't do a podcast last week because we had a bunch of scheduling conflicts. But the chart I'm showing here is the S&P 500 as of 2 Fridays ago on February 14th, Valentine's Day. And everything looked fine then. Last time we did a podcast, we talked about, the trading range that we're in. We're at the top of that range now. Are we going to break out and go higher? If we pull back, we would expect to hold the low of that range around the 6,000 level. And that was kind of our line in the sand for getting more defensive. So fast forward 2 weeks, and 2 days after that podcast, actually 3 days, 2 trading days, on Wednesday, the 19th, the market made new all-time closing highs. So we were looking at a breakout and wondering if we were going to go higher. We were positioned very aggressively. Leading stocks were acting well. But on that very day, when the S&P made a new high, under the surface, growth leaders were sold heavily, and we got out of a couple of names. And then that gross sell-off accelerated the next day on Thursday. And sometimes these happen a day at a time. It's very typical, not a surprise to have the market sell growth for whatever reason and move into value. Sometimes it's just a day or two move. And that's no big deal. If it goes beyond 2 days, there's cause for concern. So when I did that video Thursday night, I said we're watching for strength to come into the leaders after 2 days of underperformance. And we're also watching that 6,100 level, because that would be a failed breakout. And of course, the 6,000 level, which was kind of the pull the ripcord level. And that Friday, instead of seeing money come into growth leaders, they exited more quickly and furiously than they did the prior 2 days. So now we've got a serious concern going on. That was February 21st. In a matter of 3 days, we went from being very long to being completely out of every individual ticker that we owned in non-taxable accounts. You just discussed NVIDIA. And I'll follow up on that in a moment. And that's not us exercising our opinion over the market. That's us obeying our stops, watching what's happening not only on the indexes, but also in the individual leading names. And part of the success and the reason we were able to get out so quickly was the RG8, which we developed back in 2021 after a very similar weak period in growth stocks, while the indexes weren't hit as hard. Those topped and made had 3 serious days of selling, that Wednesday, Thursday, and Friday, and it actually continued on the following Monday and Tuesday before we saw an anemic bounce. So back to the beginning of this week, we're all out of individual names, and we're watching the 50-day moving average, which is the red line, and below that now, the 100-day moving average, which is very much in sync with not perfectly, but the 20-week moving average.
Right.
The last several times we pulled back, we respected that level. This was the first one that I just drew, 3 weeks. The 20-week moving average provided support on the S&P 500, and we went higher. The next one was a panic that was tied to the carry trade. We undercut and reclaimed it within a week. The next time after that, we held the 20-week. A few weeks back, we briefly undercut but reclaimed the 20-week, and then we broke the 20-week this week. That got us out of our index positions, and the index position did a great job for us as far as absorbing all the rotation out of growth and into value. I'm going to show 2 charts here. The first one is SPYV. This is a value chart, and a lot of weakness in value stocks in December. This is when the Mag 7 were really on a tear. But look at the relative strength recently over the past 2 weeks on value names, going straight up. The chart doesn't look that great, but what you really need to focus on is the relative strength line. And if you ever look at a chart without a relative strength line, you might as well not be looking at a chart, because you can't draw conclusions without comparing it to something. In this case, we're comparing it to the S&P 500. So that's SPYV, that's value. That's where all the money flowed into over the last week, week and a half. Let's compare that to SPYG. Big sell-off here, massive relative strength weakness. Compare that to the relative strength last December, or early December anyway. We had a Fed moment in here that caused a little bit of a hiccup. But there was a massive divergence over the last week and a half between big cap growth and big cap value. And it also trickled over to the mid cap and small cap indexes as well. Our RG8, let's start with, well, I'll show 3 of them. The first one is the Russell 2000 growth. This is small cap growth, massive relative weakness. FFTY, this is the IBD 50, a failed breakout and massive weakness. And then ARKK, we're going to talk about this in a second, another one with a failed breakout and then massive weakness. From failed moves come fast moves. We mention this all the time in our videos and also on our team calls for discussing. And when you see something break out and it fails quickly, you have to be wary of it moving quickly, even more quickly than it broke out, in the opposite direction. And that's what we saw here with all these growth names. The RG8 did a good job of getting us out, and not only getting us out, but keeping us from trying to rebuy some things that we thought were pulling back into reasonable risk reward areas, because it completely told us that mid and small cap growth was taken off the table because the money is flowing out of it. A lot of this had to do with Trump tariffs and fear in the market. The market hates uncertainty. It really doesn't know what the impact of these tariffs is going to have, as well as the massive federal layoffs that we're facing. And the market gets defensive when that happens. How does it get defensive? It rotates from growth into value. And that's what we've seen over the past 2 weeks. So back to the 60-minute chart on the S&P 500, which we had been tracking this range, and it went from acting as support to acting as resistance over the last couple of days. And then, of course, you see below the 6,000 level, we got more defensive, and then we failed at that was the 50-day or the 10-week. Then we broke the 100-day or the 20-week, and now the NASDAQ 100 undercut and bounced at the 30-week or 150-day today. That's the purple line on here. The S&P 500 hasn't quite gotten down to that level, but we keep we have guidelines for how much we want to be invested. Let me find this chart here very quickly. We have it's basically an index beta floor and ceiling. So in other words, what we're saying is if the S&P 500 is above certain moving averages and they're all configured correctly, ideally, we're talking about the 21-day moving average. Our ceiling is a 1 with the S&P 500. Our floor is a 0.6. As we break down through these individual levels, we take exposure off. We don't take it completely off. One of the reasons is the market never gets into serious trouble unless you break below the 200-day moving average. And there are harsh rallies after you get some of these harsh sell-offs. So we don't want to get caught getting chopped up. So we keep our index exposure not high, but we reduce it relatively, but we still are keeping some exposure in there. And that also helps fight FOMO. If you see the markets bouncing strongly, there's a big temptation to try to take a couple of shots, but we don't have to worry about that if we're getting the gains along with the index bouncing back up. And then we can see if the index repairs itself. And then we look for leading stocks now to have a follow-through day. And basically what this is a minimum of 4 days off of the bottom. Today possibly is a bottom. We don't know yet. The day's not over. But a minimum of 4 days from now, if we have a strong gain up on volume higher than the prior day, and it'll be called a follow-through day on the indexes. Then we look for stocks that are possibly coming out of strong bases with big volume. A lot of the growth names have been decimated. So our list would be slim pickings right now if we were trying to force our way into some growth leaders. They've just been decimated, plain and simple. There are some things that are holding up. Lilly in particularly has our attention because that not only has the growth component, it's also has extreme relative strength over the last month. There are a couple other ones that are decent. Starbucks, people are betting on the new CEO, showing serious relative strength on that. We stopped ourselves out of Bros because of the market weakness that didn't necessarily take us out, but this has held up above the 21-day moving average. And then you've got defensive names like Berkshire Hathaway, which is they reported earnings this past weekend and has been showing relative strength, increased relative strength since that report. And like I said, money's flowing into value areas. This is one of them. Big earnings growth, but like there's no sales growth in Berkshire Hathaway. 5%, 1%, flat, and 2%. So it's not a growth name, but we keep our eyes on stocks like this because it tells us, the tone of the overall market. And we also highlighted some value ETFs where we expected money to flow into, and those are showing serious relative strength. Here's NOBL, SCHD is another one showing serious relative strength. But it's really the breakdown in the growth names that got our attention and got us out of growth land. And then we look to and lean on the indexes to make our next decisions about what's going on there. And that's why we show every night the trend gauge broken into 4 components. What are leading stocks doing? And then what are the indexes doing across 3 time frames: short-term, intermediate term, and long-term. The market never gets into serious trouble unless the S&P 500 breaks below the long-term 200-day or 40-week moving average. This is where all bear markets occur. We haven't gotten there yet. We're only 4% off of the highs. Leading stocks, however, are 20, 25, 30% off the highs. When the hedge funds decide they're getting out and the institutions, they get out quick. So it's the quick and the dead when it comes to that. Right now, the S&P is 3% above the 200-day moving average. So, and also above the 30-week moving average, but below the 100-day or 20-week moving average. So you look to see if a prior support level flips to resistance. And if so, that's bearish for the market and bearish for our outlook on the indexes. But that level overhead, the 20-week, is up at 59.63. We're trading at 58.78, so a couple percent above there. We really would like to see it reclaim the 20-week moving average on the S&P 500. But until then, like I said, growth stocks kind of off the table. We're always monitoring relative strength. That's what we're discussing on our morning calls and afternoon calls. Now we keep a list compiled of what we're in. and a lot of ideas going around from the team, and we're kind of in waiting mode now
Okay.
for the market to tell us what to do next. Not our opinion, what the market is going to tell us what to do.
Yeah. So price is truth, folks. And so Don's showing you that chart right there. And so what I want to put my Don interpreter on. So he gave you a lot of data, a lot of hard data, stats, statistics. That's basically what this is, right? So I'm going to put my Don interpreter on, because does your advisor sound like that? Does he sound like that, or does he just want to take you to lunch or play golf? I mean, think about that. What is he telling you? So Don is laser focused on this, but I'm going to put my Don interpreter on what he kind of said philosophically for the people that aren't hardcore stock nerds, that actually came from pie charts or us, because this is a new deal. We're not doing a pie chart with emerging markets, bond stock, and all that crap, okay? We're focused on where the relative strength, like Don just said, and the strongest areas in the market, and we want to avoid the weakest areas. Don always says, why would you buy rotten? You don't buy rotten fruit and vegetables to get a balanced diet. You only buy fresh fruit and vegetables. We're trying to buy fresh fruit and stocks, not rotten fruit and stocks, okay? But you know, there's stats like if during a bear market, the average monthly return is negative 2.6%. Right? Well, yes, that's true, but did you know that it's really the first 2 months that go down 30, 35, 40%, and then for the next 5 or 6 or 8 months on the recovery, it kind of chops its way back up. So the third and fourth month could be up 3% or 5% or 2.5%. But it's just making that average negative, because the big losses happen at the beginning of the bear market, and it happens quick, like Don said, the quick and the dead. So if you don't have an advisor that is ready to really move quickly, to move to cash, and we're not day trading, we're not just going back and forth. That's why he has those layers, the 50-day moving average, the 150, the 200-day, and even the shorter term, the 21 exponential. So he's got all these different layers, and we'll take them off in layers. So you're not just day trading, but you're also managing risk. And when growth stocks are out of favor, they are out of favor. Growth stocks fall on average 60, 72% from the top, the leading stocks, right? That's what Tesla did. Tesla's gotten slaughtered. You know, last year it was a great stock to have, 6 months ago. Things changed. You cannot buy and hold these things, and that's what they're doing constantly. We're not doing the pie chart, and we're actually saving drawdown. We're drawing down much less than the markets, but getting market-like returns. I mean, that's a good risk-adjusted thing, because you don't have to go change your underwear every 4 or 5 years when you lose a third of your money. It's a better way to do it. So with that, I just wanted to talk about that, because what he's saying mathematically, all that stuff that he gave you, all the stock nerds got it, but the people that are kind of just trusting us and letting us do it, I'm trying to explain philosophically what he's saying. He's using mathematical rules to get defensive, to raise cash when it's getting dangerous. Cash or hedging is your defense, not diversification. Diversification will take you to the woodshed. Okay? On the way up, we'll have just enough diversification. On the way down, no diversification. That's a different way. We are different than 95% of all the advisors out there that are pie charts or us advisors by the sell side with conflicts of interest, taking your money and giving it to their clients. So Don, show them how we do it. Let the guys show them.
Yeah, we'll do. One other thing I want to mention. This is a chart of the Russell 2000 small cap index. I mentioned we're between 4 and 5% off the highs on the S&P 500. This is 14 to 15% off the highs in the Russell 2000. This weakness was again really highlighted in the RG8, but you can see how the 21-day moving average rolls over. That's the green line. Then the 50-day. Now the 150-day is rolling over, and the 200 is flattening out. This is what the next step down in the S&P 500 would look like. It was about 10% off the highs when we broke the 200-day moving average. On the Russell 2000, it'll be around 8% off the highs. 7-8% off the highs when we do it for the S&P 500. That's easily recoverable. It's what happens under this black line, the severe bear market. the Atlanta GDP now is now forecasting a recession for Q1. So there's obviously very much cause for concern. That concern is being reflected in the market. Sometimes the market just rotates. Sometimes capital comes out of the market. First time it's been just a rotation from growth into value with some weakness. But if we start to break these other longer term moving averages, then we'll get even more defensive than we are now. And we already started adding some shorts in the TurboTection portfolio. We'll start adding those not only to Grotection, but increasing their frequency and the amount we have invested in them.
Yeah, that's a great point. So, folks, I want to make sure you don't miss. Don just gave a gold nugget, and he kind of said it. So, folks, when the market starts to get weak, when you're moving up at all-time highs at CNBC's, having cocktail parties at the closing bell, right? Everybody's cheering. When it's going up like that, when growth stocks will sell off first, they'll start to pull off, and they'll start pulling off hard. And so the NASDAQ or the growthy areas pull back. And a lot of times, like Don says, there's a rotation to quality, a sector to value, whatever you want to call it. So defensive names, dividend names, or even bonds. So sometimes the NASDAQ itself will pull back a lot, double digit, but the S&P will only go down 4 or 5. It doesn't get really ugly that's just a rotation. But then if the S&P also goes, the values start to go, that means the whole market is going, and that's when you got to move to cash quickly. So at first you start to rotate from growth to value, and then you may actually get very defensive or even go flat or net short. All right, I just wanted to clarify that, Don. I didn't want to, because you made a great point.
Right. One other thing we want to point out, you mentioned the hedge on NVIDIA. It's not just NVIDIA that we do this for. We have a bunch of clients that brought in large capital gains in legacy positions like Microsoft, Google. We hedge those as well. So if you've got big legacy positions with an advisor that's just going to sit there like a deer in the headlights and not do anything to protect your downside, like I said in the video that I did Thursday night, now's the time to bring your account over to Revere, not when it gets run into the ground by somebody that has no sell signal, either through unconscious incompetence or willful ignorance. It's one of those two. Some people don't want to know anything about it. Other people know about it, but don't want to learn about it. It's up to you. It's your money. They're not going to protect it. They're not going to protect it. They tell you to think long term, and that's fine if we're all oak trees, but we're not.
Yeah, and the legacy positions have a lot of risk. They introduce a lot. And look, people get married to the idea because they work for the company, they love it and stuff. That's where their salary comes from. It's like a big bond, a life bond. So if you're getting more of those stock warrants or whatever, you're getting refilled every quarter. You want to diversify away from your legacy position or at least hedge it, because if it's 20, 30, 40, 50% of your portfolio, you're taking way, way more risk than you think. Just because you think you know about the company you work for, there's a lot of things that could go wrong. So anyway, all right, Don.
All right, first we're going to start off with Connor, and he's going to talk about semiconductors and a couple of other tickers. And I'm showing the SOX up here on a daily chart. Connor, take it away.
Yep. Today segment, I want to talk about some stage 3 tops, along just with some general shorting guidelines and some precedents that I went back and looked on. And so, yeah, Don's got a chart of the SOX, which is the semiconductor ETF. And before I get into this, I kind of just want to talk about some general points about shorting and some things I've noticed when you go and look back at, some things that made big moves down. And so with semiconductors, I always like to take a broad look. You can look at the ETF, but you also want to look at, all the components in the ETF, and then as well as just general stocks in the sector. And one thing that you tend to see in a topping market or a topping sector is a lot of stocks breaking out from third, fourth stage bases, running up and then failing hard, like Don mentioned with ARC, from failed moves come fast moves. So when you start to get in the later cycles of a run on a stock or an asset class, you see these third and fourth stage bases start to become very failure prone. And that brings me to my next point: is a top is a process, not an event. And most tops occur, or the breakdown shorts occur about 5 to 8 months from the actual top. And usually what makes the best shorts is big leaders from the preceding bull market that have had large price advances. And then another key point is that big leaders that have massive fund ownership. So, an institutional darling, when the stock starts to come under pressure, they can trigger like a big wave of selling. So that now we'll take a look at stocks, and we'll take a look at some of those characteristics. So stocks topped in July of 2024. And that point that I just mentioned, the best shorts come about 5 to 8 months after a top has been formed. And that is about the timeline that we're in right now. And if you pull up the daily, Don, and stocks is starting to break down a little bit. Another common characteristic in topping processes is multiple failed rally attempts above the 50-day moving average. So semiconductors put in that high in 2024, and you can see they tried to reel you in numerous times, looked very convincing, right? Semiconductors have pulled back. You get the value trap. People are like, oh, the valuations are down. It's back above the 50-day moving average. Tried. Each one was met with sellers, and it failed all the time. And then you started to see all those moving averages starting to flatten out. And once you start to see that 50-day cross below the 200-day moving average, that typically tends to be your trend confirmation that any pops are likely going to get sold. And then we can just talk about, and then the catalyst. So a lot of people were looking for NVIDIA to spark up semiconductors on earnings yesterday, and that clearly wasn't the case. And so that was another news failure per se. And so stocks had a rough day yesterday, breaking down. So we'll see. It's bouncing back a little bit today, but to me, the trend looks down, and it fits most criteria for a stage 3 top heading into stage 4. But with topping, like I mentioned, it's a process, not an event. This could very much rally back up into the 50 or 200 day, and could reject again, could try to rally back up. But the evidence to me on this is that it's looking more like a stage 3 versus a constructive base. And so when I was looking at this, I found some, pretty interesting similarities. I'm going to have Don pull up the ARC 2021 breakdown. So you can just go in February of 2021. And this had very many similar characteristics into semiconductors right now. And another point that I also want to make is this was very similar, is that semiconductors topped last year, much before the market topped, and so did ARC. ARC was the leading, or Don put 2022 actually. ARC was the leading sector in that run that we had, and so was semiconductors. So I found that similarity interesting. But this one looks just very similar to stocks. You had that kind of blow off top, and then you had the 50-day cross below the 200-day. You had multiple failed rally attempts above the 50-day, and then you got that steep move down once all those moving averages started to slope down, and price started to head lower. And then last one is Cisco of 2001. And this was another institutional darling of that bull market, a favorite, had one of the biggest price advances and was extremely owned by nearly every institution. And this one, again, had a very similar setup, blew off. And then about 8 months later, after that local high was put in, it had multiple failed rally attempts above the moving averages. And then once they started to fully turn over, this saw a huge move down. Just kind of very similar to what we're seeing in stocks right now.
Connor, this is the actual stock. This is the specific stock, the specific chart, and the exact specific time that cured my own father of buy and hold. He owned Cisco from the early 90s with a cost basis of $2 a share and rode it up to almost 80. And I was trying to get him to sell it. and at least put a 10% stop loss. Oh no, the economy's doing well. Well, in about 2 or 3 months, he lost so much money, it scared him to death. And he called me and said, I will never question you again. You do what you think's best. Thank you. And I never, ever, it made him a compliant client. That's my personal story, and I'm sticking to it. Go ahead.
No, yeah, that's everything I got on.
Cisco is the equivalent of what NVIDIA is now for AI.
Yes,
Back
yes,
then in
yes.
2000, 20 years ago, Cisco was like, there's no way this is a put it in a drawer and hold it forever name. They're the
Yep.
backbone of the internet. Nobody's
Yep.
ever going to surpass what they're doing.
Yep.
And no matter what you think, the chart is the truth.
Price
Great
is truth.
Great segment, Connor. That is we use precedents like this all the time, and it's hard to say that this could happen with RK or with semiconductors or with NVIDIA, but it absolutely can.
Hey, by the way, Don,
Right.
perfect example. Listen, coming out of the COVID bear, Tesla was one of the best performing stocks, and it was one of the best performing stocks for the next months. But in 2022, it lost 69% and was one of the worst. It was the worst performing stock, I think, in the S&P 500, and then opened up 2023 up and down another 20 to 30%. So it gave all the gains back that it had made the previous year in 2021. That's why these growth stocks, you cannot buy and hold. You can't really buy and hold anything, really. But you've got to be able to manage these, to manage the risk. All right, who's up?
All right, let's go to Ted now. He's going to give us a little bit more detail on NVIDIA.
Yeah, so zooming into the semiconductors sector, I'm going to talk about NVIDIA. I talked about raising some red flags on NVIDIA 3 weeks ago on the February 7th podcast. I also talked about ANF and some other potential shorts on that podcast. So now to the present day, yesterday we had, 2 days ago, NVIDIA reported earnings, another double beat and raised quarter, which means they beat on revenues and beat on earnings. They also raised guidance on earnings as well. We pretty much gapped up slightly, non-materialistic, and just faded all day. Huge bearish engulfing, taking out the 50, the 21. Is that purple one the 8 or no? That's your 150.
That's
right,
the one.
Don?
Yeah, that's the 150 now. We're not
Okay, yeah.
paying as much attention
Pretty much,
to the 8.
yeah. So we talk about the power of 3. This is like the power of 5. We broke the 50, 21, 150, and 200 and closed below the 200-day. On the weekly, broke below all the key weekly moving averages as well, 10, 20, 30, and 40. So that's just some really bad signs from NVIDIA. Don highlighted that the volume came in higher than average as well. And this is just one of the news failures in NVIDIA in this huge top that has formed. This current top rhymes with the SOX, Semiconductor, Cisco tops, but it's not exactly a mirror of it, because the recent top was only a couple of months ago or a few months ago, whereas the previous examples Connor gave, those tops formed 5 to 7 months ago. However, we only really spent a couple or a few weeks above that 140 level. So to me, you can, in a way, point to that left side peak, that 140 peak, as the quote unquote top. And if you do measure it from there, it is about that 8 to 9 month period where a stock forms a top and then rolls over. And to the points and to the price action that briefly broke above 140, one was on earnings last quarter. Once again, double beat and raise, but couldn't even push past 150 and fell back into the base. Then it oscillated, chopped around for a few weeks, started rising on the optimism of the CES event, where technology companies reveal their new products and services, try to break out into new all-time highs once again. Huge this day. Then following that, we had the deep sea gap down on the highest sell volume in one day, really in this entire base. So those are just 4 or 5 key red flags in the topping process of a stock. Then we rallied on declining volume, which just means that no real buyers came into NVIDIA, came back to that left side peak that I talked about, that significant 140 area, reversed into earnings, and then really, we're just hanging off a cliff right now at this point. The key level for me, though, to really officially label this as a stage 4 decline is below 110. That's the break of the key support level and break of structure. And I think it could get quite ugly under that level if it does break it. And like our previous precedents, like Cisco, ARK-K, and now the semiconductors ETF, and what Dan talked about, on average, these leaders fall 50 to 75%. Well, on average, 72 to 75%. And that would really put NVIDIA back to $50 a share. And that's definitely in the realm of possibilities. People that don't think it's possible have not studied history. And just went over some history with you guys.
Absolutely. And there's a lot of pain going down to that level you're talking about. I mean, that's about an 8% drop from here. So that's talk about pain. So how do you manage that? Right now we got it hedged, right? So
Yep.
You've got to manage these positions. You can't just let them go. All right.
And just my final and then my final point with NVIDIA is that relative, why I call the 140 area the quote-unquote top is because that relative strength line made its highest point. And when we continue on to the next all-time highs up into 150, that RS line is actually below that left side peak. And that is a really subtle sign that William O'Neill looks for in identifying topping stocks. So that's all I want to talk about with NVIDIA. Even though it's the darling, growth cycles eventually end. Companies can't grow forever at 100% growth rates. It's just the law of large numbers. And here's the key point with growth stocks. They move up because of the acceleration of earnings and revenues. Once that rate of acceleration or second derivative falls, that's usually when they've topped. And it can get definitely ugly from there.
Right. Blue sky.
So the next one I want to talk about is VRT. Yeah. The next stock I want to talk about is VRT. And they are all over the data center construction just map. They do liquid cooling and some other parts of data centers. And this one broke into stage 4 as well. This top is still really sloppy. It's not like the NVIDIA stocks, ARK-K and Cisco tops, not like the textbook tops we talk about, but still has rolled over to stage 4. And right now I wouldn't short it, but just looking for any continuation bear flag or rally into key moving averages. You can see those longer term moving averages flattening now and really starting to turn down. Once we get that full bearish alignment with the 8 below the 21, below the 50, and the 50 below the 200 and 150, that's where you can really have some nice smooth trends on the downside. And so that's it with this one done. Again, actually, I'll point out one more thing. A huge failed breakout, and many of these tops start from failed breakouts. And like what we say, from failed moves often come fast moves. And this is quite a move so far, from over $150 a share to now sub 100.
Wow.
A third name,
30
I'll just
your
quickly
money.
go over.
30 your money very shortly.
30 your money in a few weeks. Yep. A third name also involved in the data center area, providing power to CoreWeave is Core Scientific. They're kind of a hybrid between Bitcoin mining and data center, and selling their power for data centers. This one is well over 33% off highs as well. This is also broke down into stage 4 decline. And why I like to target this one as a short, it pretty much has no fundamentals, it has zero earnings, pretty much in its entire life cycle, and minuscule revenues as well. You can see that RS line just has been declining for weeks and weeks. It's also gapped down on that DeepSeek news, barely rallied, couldn't get back above to the 50-day, and has completely rolled over in stage 4 so far. And actually, this one is starting to look good for potential short opportunity. It's wedging up into the 200-day moving average. So just another one I'm looking at for potential short here. I do want to note this one definitely has higher ATRs, so you do have to be mindful with your position sizing and handling the volatility of the stock. Fourth one is a retail restaurant name, Cava. This one also made extraordinary move in its uptrend in this recent 2-year bull run. And like what we talked about, many of these tops come from failed breakouts. And Kava pretty much saw one of the best earnings quarters in its move up, and that was the top. And so far, we are down over or nearly 50%, I think. 173, now we're at 90. So nearly 50% from that failed move on earnings. And this is also in the stage 4 now. Relative strength made new lows with price. And same thing here. Looking for a bear flag or rally into those key moving averages.
The stock, not we. We don't know. Not we, the stock. Yes. Just want to clarify
not
that,
we,
Ted.
Yeah, the stock.
Yeah. Okay.
Yeah. And then quickly, the fourth one, VST. Another one of those names in this AI infrastructure theme. And you can see many of these stocks have completely rolled over as well. And this one is not in stage 4 yet, but I do wanted to include an example that is in the topping process in stage 3. DeepSeek failed breakout, catalyzed by a news event there. Tried to rally back above, and then it has failed so far. And that relative strength line also making lower lows with price. And this is just one to monitor as it builds out a top before timing that breakdown entry. So I just wanted to include a stage 3 example as well, for just to give an example of what an earlier topping stock may look like.
Very good, Ted. Thanks so much. And it's crazy how the devastation in some of these darling names can manifest itself when the market just decides that they don't want to own it anymore.
Absolutely. People got to realize that leading stocks actually lead on the way down too. They don't just lead on the way up. They lead on the way down because big hedge funds and institutional money take profits where they got the most profits quick. So they hit where they got the most gains. Those stocks are going to sell off the most. And Don's right. Any time's a good time to come to Revere, but the best time to come to Revere is before the next bear market. I'm not saying it's happening now, but it could be setting up. I mean, those charts don't look really good. We're kind of teetering. We're at a pivotal moment here. All right, Don, who's Todd we got next?
Yep. We're going to take it over to Todd. He's going to explain how Head and Shoulders is not just a dandruff shampoo. Take it away, Todd.
That may make the headline.
Love it. Well, there's so many things to talk about on Microsoft's chart that are wrong with it. And eventually we'll go to the daily, and we're going to see a lot of the same things that Ted talked about with NVIDIA and other stocks. But we're going to address a pattern called the Head and Shoulders pattern. And what this is in classical charting, it's a reversal pattern. And it's a reversal of the previous trend of the stock. And obviously Microsoft has been a long-term leader. It's been a stock that people have hundreds, if not thousands of percent gains on over the years. But what we have here is a 9 to 10 month Head and Shoulders topping pattern potentially going on with Microsoft. Overall, on the left side, you can see this was in March and April of last year. That was the left shoulder. And then at the peak of the pattern, you have the head, which was formed in June of last year. Okay, then you had a sharp drop, okay, which formed part of the neckline around 387. And basically on that neckline, you have several touches, or you want several touches around that neckline to form that bottom of the pattern. And then you'll have the rally up into the fall of last year, which formed the right shoulder, which was slightly higher than the left shoulder. And then you had some fractals that came in, and you can see a little bit of a trend channel that formed off of that, but ultimately failed here 5 months ago. So the way this pattern works is you take the high of the pattern, which is $468, down to the neckline, which is around $387. And that's about 17% or 81 points. Okay? So what you do from here is once that neckline's broken, and in classical charting, they'll use like a close 1.5% or 3% below the neckline. So, we're going to say approximately a close below $381 would trigger the completion of this pattern and the start of the breakdown. So we're still technically not in the breakdown phase of this yet, but we're very close. And Don, if you could go to the daily chart of Microsoft on Market Surge, please. Okay. So going back to the base or the neckline, you can see it's almost perfectly in line with what Market Surge is showing the current base. We basically retested that neckline again today, but so far held it because we're pretty oversold and we're getting a little bit of a rally in the market. So what we're going to want to watch for over the upcoming days is maybe another couple tests of that neckline, or perhaps an outright break coming up fast. So we don't know what the coming days are going to bring us. But if this eventually breaks that neckline, that target is around $320 to $325, which is about 17% from that neckline. Or if you want to go on points, it would take you down to about 306. Okay, but looking at this pattern too, it has several of the aspects that Ted talked about and Connor, where you have a lot of distribution days since last summer's lows. You go through this pattern and you see many high volume distribution days. Okay, you've got the black cross going on here where the 50's crossing below the 200-day moving average. And you've got several failures where the stock broke below both the 50 and the 200 along the way. So this is just a very, very weak chart. And it's not just the head and shoulders pattern here. You could have definitely shorted this on the earnings day when it gapped down below the 200-day moving average at the end of January on earnings too. So there's many entries into this, but ultimately you're coming up on this big head, this 9-month head and shoulder pattern. Continuing on with the head and shoulders, I'm also going to give an example of Tesla last year, which put in a inverse continuation head and shoulders pattern. And what you can see here is, I'm going to just pull up mine because it's a little hard to see. So you have that left shoulder that developed around the fall of 2023. And then you have the head, which formed this past spring of 2024. You had the rally attempt and then a pullback to the right shoulder in the summer of last year. Okay. And then you have that line going across those highs around 271 to 275. Okay. And same thing, you look at the bottom of the head on this pattern, which was 139. That took place on April 26th, up to that line around 271 at the high, and that's 132 points. Add that to the 271, and you got a target of 403, which this was a very successful completion of that inverse head and shoulder. And interestingly, Don, if you go to a daily chart, please, on Tesla on Market Surge. Okay, you'll notice we got up well past that target, but today we actually came down to the 200-day moving average, and so far that was actually the breakout point from that inverse head and shoulder pattern also. So right around that 275 area, we've so far come back and completely reversed that whole pattern and are now testing that. So whether Tesla holds it here, you've got the confluence of the 200-day and that breakout from that inverse head and shoulders. And that's all I wanted to talk about.
Excellent. So the takeaway, head and shoulders bearish, inverse head and shoulders bullish, and you can get a target to the upside and the downside by calculating the difference between the head and the break point below the right shoulder. Great stuff, Todd, and probably not something you'd ever hear a pie chart advisor discuss. Dan, that's everything from the tech side this week. Take us on home.
Oh, well, listen, thanks. On the bright note for Microsoft, even though it looks bearish on the chart, my man crush, Don thinks my man, Jeff Goonlock did come out and say that he thought that Microsoft may be safer than our government treasury debt. So there is that. Anyway, one other point for you chartists, and I'm not sure it'll work on that, Todd, but I think if you actually put, if you're used to looking at head and shoulders charts on Thinkorswim, not the other way around on the bottom, if you put a negative in front of that, it'll reverse it flips the chart. So it may help you if you're looking at, if you're trying to go long, a regular head and shoulders chart is normally bearish. So if you're wanting to look at it in a bullish light, you can put a negative, and then it looks like the short chart. In any event, folks, listen, thanks for listening. If you like what you heard, or if it's just a little too much and like drinking out of a fire hose, but you want someone actually managing your portfolio with that precision and that measurement, rather than just a bunch of mutual fund or ETFs and a little pie chart that kind of flows along and gets crushed every 5 or 6 years, there's a better way. Just go to revereasset.com. Up in the right-hand corner, just subscribe to our newsletter. You can go to YouTube, Revere Asset, just Revere Asset, hit subscribe. This podcast will go to your inbox before the market closes today on Friday. That's how our stock nerds do it. And you can, and then next to it is a contact us button. You'll send me an email directly to me. You can ask for a ticker you want talked on the show, a topic or whatever. And you can always call us old school at 855-REAL-WEALTH. Folks, don't let them take your money and put it in a Pie Charts or Us portfolio. Those don't work very well, and they go drop a whole lot. Learn a better way to invest at Revere. We'll talk to you next week on Your Money, not Their Money, Your Money.
Because it's not how much you make in the markets, it's how much you can keep.